Hey guys, Kevin Kim here, coming to you with a news update. As many of you know, UBS has recently purchased Credit Suisse for $3.2 billion. This is interesting news, to say the least. Concerning news, definitely, as another piece of the banking market starts to crumble. We here at Jurassic are watching this very carefully on its impact in private lending. And one big concerning point of this purchase was there was a write-down of about $17 billion of convertible bonds. They'll either be converted to equity or they're written down. And this is a pretty big sum of money. And the downstream effects of this are pretty significant, considering that a lot of the other big banks out there were buyers. Deutsche, BNP, a lot of these European banks were buyers of these bonds. After everything, what does this mean for private lending? And I want to start from the grand scheme of things, big picture, right? And I think big picture, my takeaway from this banking crisis, first of all, this is not 2008. I don't think it's 2008. I think it's just it's definitely not as bad as 2008, but it's also nothing to be as concerned about in 2008. But at the same time, it does raise questions about how can we prepare for what's coming? How can we react in the short term and the long term? Now, in the long term, in the grand scheme of things, I think this is actually going to be a positive thing for private lending, because it will enhance the ability for private lenders to be private lenders. What do I mean? What do I mean by that? I think it's going to preclude banks from ever lending in real estate, especially, ever again. I think they're going to be having to become much more conservative, either through forced regulation themselves or through government regulation, and it's going to preclude them from ever jumping back into the mortgage space, whether it be commercial real estate, residential real estate, or private lending. At the same time, there's going to be these short-term concerns, right? A lot of our clients are stressed out when it comes to depository relationships and the lender finance relationships with various banks. At this juncture, I'm advising clients, I think that they should be contacting their banking relationships, number one, and getting a clear statement of what's going on. Number two, they should really be thinking about diversifying their relationships with local community banks. I think at this juncture, it's probably best practice to have at least 2 depository relationships for your accounts, if not more than that. And when it comes to your lender finance situation, if you have multiple lines of credit, I think you're in a better position than most. You probably have diversified strategies. You can rely more on one bank than the other. My concerns right now are some of these banks that are in a stressed position. Are they going to either be canceling new lines that have been recently be approved, or will they be more stringent when it comes to renewals? Things like this are going to come. I think it's a foregone conclusion that it's going to come. I think it's imperative on us as borrowers in this context to really get prepared for this, but also start looking for other resources for lender finance, but also for capital. Ultimately, this is about capital. And so one of the biggest takeaways from this, much like during the 2020 crisis and the 2022 rate hike, I am urging our lenders to really think about being a balance sheet lender and controlling the capital that you are using. And what do I mean by this? Debt funds, REITs, private note offerings, raising the capital either yourself or through trusted intermediaries like registered investment advisors, managing broker dealers, and stuff like that are a very, very good option right now. There seems to be a significant appetite still when it comes to high net worth investors and endowments and stuff like that. So I think that it's incumbent upon private lenders right now to really go out there and raise the money. Sure, you're not going to be having the amount of leverage that you're probably used to having. If you already are one, you may have some cash flow restrictions because of that. But I think in the grand scheme of things, it'll better your business by raising more capital anyway, because the cost of that capital on the debt has been increasing so significantly where you've already probably been pushing the capital raise on the equity table as it is. So private lenders right now, if you haven't already made the jump over to being a balance sheet lender, I would strongly urge you to consider it based off of what we're seeing right now in banking as well as in just capital markets overall. And if you guys have any more questions or are concerned about the condition of the banks and what we're hearing from our relationships, or what other strategies you can establish to build your business further and kind of protect yourself from the oncoming stresses that will come, please feel free to contact us. Myself, my partners, we're here to help, and we're happy to advise you through it. Thank you very much.